Good morning, friends. Today, I am going to explain the bottom reversal entry setup using volume, open interest OI, and OI change. This setup helps us identify strong support levels where institutional traders or big players are active. Let's understand the conditions one by one. The first condition is that the put volume should be greater than the call volume. High put volume is one of the most important signals for identifying a potential reversal. When the put writer volume is greater than the call writer volume at a particular strike price, we consider that strike to be a strong support level. This indicates that put writers are aggressively defending that price. The second condition is to identify the presence of big players. At the strong support strike, both put volume and put open interest should be at 100%, which means they are the highest among all strike prices. In addition, the put side out of the money, autumn divergence should be significantly higher than the call side divergence. This suggests that institutional traders are actively building positions at that support level. The third condition is to compare call and put activity. At the strong support strike, the combined put volume and put open interest should be greater than the combined call volume and call open interest. At the same time, put OI change should be lower than call OI change. Now you may ask, why should call OI change be higher? A higher call OI change represents counter positions. These positions create an advantage for the market to move upward because they represent potential stop losses of call writers. If the market starts raising, these stop losses can be triggered, adding further buying pressure and adding advantage to the reversal. The next condition is that the support should remain stable. As the market approaches the strong support level, that support should not shift to another strike price. It should continue to hold the highest volume and open interest, showing that put writers are still confident about defending that level. Another important condition is holding. Even if the market temporarily crosses the strong support level, the 100% put open interest should remain at the same strike price. This indicates that put writers are holding their positions instead of closing them, which strengthens the probability of a reversal. Next, observe the trading volume carefully. The volume should not suddenly double or increase sharply, because such a move may indicate position unwinding rather than fresh position building. Finally, watch how open interest shifts. If open interest moves to a lower strike price without a corresponding increase in volume, the market is likely to reverse from that level. On the other hand, high open interest supported by high volume indicates fresh position building, which is generally a stronger and more reliable signal. To summarize, a high probability bottom reversal setup requires put volume greater than call volume, maximum put volume and put open interest that is strong support strike, put OI change is less than call OI change, strong participation from institutional traders is at strong support, stable support with no shifting, put writers continuing to hold their positions, no sudden volume spike due to unwinding. Any shift in open interest should be confirmed by volume, otherwise a reversal is more likely. When all these conditions occur together, the probability of a bottom reversal increases significantly. How to plan a trade at bottom reversal? Always wait till price reach day low. Find reversal point like previous day demand zone, previous day low, close or high. Draw the liquidity zone. Once volume spread analysis, VSA, candle is formed, take the entry on its high and low will be stop loss. Plan target at maximum call OI value. Now let's analyze another real market example from 6 February 2026 to understand how to identify a bottom reversal setup using the option chain. The first thing we observe is that the 25,500 put strike is a very strong support level. At this strike, the put side has high volume, high open interest and strong open interest change. This combination tells us that institutional traders and option writers are actively defending the 25,500 level. In other words, big players are waiting at this strike with heavy positions, making it a strong support zone. Now let's compare it with the 25,500 call side. At the 25,500 call strike, we mainly see high open interest change, but the trading volume is comparatively low. This indicates that fresh call positions are being added without equally strong participation. Such a pattern may suggest that smaller traders are becoming bearish, while larger market participants continue to defend the strong support. However, this observation alone is not enough to make a trading decision. It should always be confirmed using price action and market structure. Another important point is that call open interest change is greater than put open interest change at this strike. This tells us that fresh call positions are increasing rapidly. When we analyze this together with the strong put support, it indicates that the market is preparing for a possible upward move rather than continuing the decline. Now let's look at the lower strike prices. We observe high put open interest at 25,450 and 25,400. This suggests that the market is gradually shifting upward. As the market accepts lower strike prices and institutions continue to build positions, the probability of a bullish move increases. Finally, wait for a bullish VSA candle or price action confirmation before entering the trade. Now let's understand one important bullish reversal setup using the 25,400 strike. First, look at the 25,400 put. It has high volume, high open interest, and high OI change. When all these three indicators are strong together, it tells us that big players are actively writing puts at this strike. They are confident that the market will not fall below 25,400, so we can consider 25,400 as a very strong support level. Next, observe the 25,400 call. Yes, the call OI change is increasing, but the trading volume is low. This is very important. OI change alone is not enough. If OI change increases without strong volume, it means big players are not actively participating. Most of this activity may be from retail traders. This is often a retail trap. Now compare the OI change values. At 25,400 put, the OI change is 20.19 million. At 25,400 call, the OI change is only 13.11 million. This means put writers are much stronger than call writers. The buying confidence is greater than the selling pressure. This is a positive sign for the market. Now look at the resistance. The highest call open interest is at 25,600. So, if the market moves up from the strong support of 25,400, the next target or resistance is likely to be 25,600. Now remember one important rule. Don't look only at OI change, always compare it with volume. If the put side has high volume, high OI, and higher OI change than the call side, it indicates that institutional put writers are supporting the market, and the probability of an upward move is high. On the other hand, if the call OI change becomes higher than the put OI change, and it is supported by heavy call writing volume, then the resistance becomes stronger, and the bullish reversal setup becomes weak. So in this example, 25,400 is a strong support, put writers are dominating, call writing is relatively weak, and therefore the probability favors a bullish move toward 25,600. This is how you should analyze the option chain before taking a reversal trade. Thank you.